Hey guys, I often joke that Proforma is Latin for fiction. This is especially true when you're analyzing the numbers in the financials of an offer memorandum in a multifamily deal. Now, if you don't know me, my name's Agostino, and I'm a real estate entrepreneur, syndicator, and investor. Here, I share my stories, lessons, and advice from my journey in the multifamily real estate game. If you haven't subscribed already, go ahead and push that subscribe button now, turn on notifications, and leave a review or comment. I'd love to know who you are and what you're up to. Today, we'll speak about how to evaluate the financials of a deal that you want to buy. I'll tell you how to know if the numbers presented are realistic and maybe some rules of thumb that you can keep in mind when you're taking a look at the numbers and evaluating what's in front of you. So an offering memorandum is a piece of marketing material. It's a marketing document created by a listing broker to tell buyers in a market about an asset that they are selling. Note the key word I said, marketing, okay? It typically contains photos, projected financials, and sometimes a history of the property to give the buyer some insight on the property's condition and the financial performance. Now, because it's marketing, it's meant to entice buyers into taking a closer look at the deal and possibly submit their highest offer. It is rarely based on real financials and often just based on assumptions. So if you're at your desk when an email comes in from a broker and it's a new deal in a decent part of town, the price seems to be higher than what the market is at, but the broker says the cap rate is in line with the area, implying that the valuation is actually correct. Then you dive into the Proforma financials and you have to determine their level of accuracy. So here are the three things that I look at in the Proforma very quickly. So first, look at the numbers and if they end in zeros, okay? For example, if the NOI says exactly $900,000 and the income and expense line items all end in zeros in the same way, chances are the rest of the numbers are all made up. When was the last time you went out to dinner and the bill is exactly $100? The same thing goes for multifamily property. There are so many tenants, vendors, expenses, and income items. I've yet to see the actual financials of a property where every single line item ends in a zero. Just doesn't happen. Number two, look at the cost per door. If you're active in your market and you generally know what the average rent is for a given area, so for instance, if we're talking about a C-class area in Pittsburgh and the average is $47,000 a door for a $650 rent level per unit, I know that I shouldn't pay $75,000 a door. It won't support my cash on cash targets for me or for my investors. It doesn't mean I won't look at the deal. It just means that I need to take a look at the upside to see what justifies that asking price. And third, look at the expense ratio. A general rule of thumb is that expenses are 50% of gross income. In general, in apartment buildings where the tenants are paying for electricity, landlord typically pays for water and sewage. I expect expenses to hover between 53 to 59%. Anything more could mean there's an opportunity to get expenses under control. When you see an expense ratio sitting somewhere around 30 to 40%, it's probably not accurate. A well-run large complexes where the tenant is covering all their expenses as far as utilities, you may see something sitting in the 40s, but that's about it. That's very rare. Those are just a few of the things that I look at when I'm reviewing the financials in a Proforma. I do look at other things such as taxes, insurance, and utilities. When real estate is hot, like it is now, cities and municipalities turn up the tax bill to capitalize on all these real estate transactions. On several occasions, I found that taxes on a Proforma were not actually paid current by the owner, or it was the same as it was when they purchased it a long time ago, not reflecting what it's going to be today. So make sure the taxes are all paid current and they match up to what's in the offering memorandum. Now, your title company will make sure that taxes are paid before the property transfers, but you want to make sure the property generates enough revenue to pay all those expenses, including those taxes, all right? If skipping taxes, it might impact your net revenue, you see. As a side note, keep in mind that the taxes will likely go up after you make that purchase, so you need to account for that in your underwriting, okay? As far as insurance is concerned, I have a great relationship with my broker, and I typically get good rates as I'm able to put the asset under my umbrella policy. I always base my underwriting analysis on the financials in the offering memorandum given to me by the broker if I decide I want to move forward. If I don't, I call the broker and let them know why I'm not interested in the deal, okay? Regardless, you want to verify the numbers and you want to anticipate any and all expenses in your underwriting. Anyway, what do you do when you get an OM emailed to you? More importantly, how soon do you contact the brokers with questions? Let me know in the comments. I can't wait to chat with you there. And, if you like this content, go ahead and give it a thumbs up and share it. Also, check out the Bulletproof Cashflow podcast on iTunes or Stitcher and subscribe to the YouTube channel as well. And again, don't forget to hit that notification bell so you can get notified when we put up new videos. If you're looking for more content or even some coaching, reach out to us at bulletproofcashflow.com. We're working on getting some new content to you guys out every day. So please go ahead, subscribe, and good luck. Be great, guys. Talk to you soon.